Get the full global macro and markets picture with Capital Economics' all-access packages. CE Essential gives you full access to all of our award-winning written analysis, all of our online briefings, and a host of critical data tools. And for deeper engagement with our economist team, our proprietary data, and seamless integration of that data into your workflow, CE Advance is our most complete solution. Go to capitaleconomics.com today to learn more about CE Essential and CE Advance.
It's Friday, the 1st of August, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, AI's energy demands. Where will the power come from to drive this technology? But first, Neil's out, but I'm happy to say that Jonas Goltermann, our Deputy Chief Markets Economist, and Stephen Brown, our Deputy Chief North America Economist, are with me to dive into another week in macro and markets. Hi, Jonas. Hi, Stephen.
Hi there. Hello, David.
It's been quite the week, hasn't it? It's ending with a bang and a whimper. I should caveat, we're recording this at 9 a.m. DC time. Anything can happen. But Stephen, lots to talk about, but we have to start with that July employment report. 73,000 new jobs in July. I mean, that throws the cat among the pigeons, doesn't it?
Yeah, that wasn't even the worst part either. So the big negative in this report is the combined 250,000 downward revision to payrolls in May and June. So those are coming in now at just both less than 20,000. And remember, this is at a time when the healthcare sector is still adding close to 60, 70,000 jobs per month. So if we just look at private sector excluding healthcare, it's down by 50,000 over the past 3 months, despite bouncing back a tiny bit in July. So it's definitely a pretty shocking report. It suggests that the labour market is a lot weaker than we maybe thought going into this one.
There's this growing narrative, isn't there, that the US economy is slowing. This isn't the only data release we've had this week. So what's the picture showing? How quickly is the US economy slowing?
Yeah, I mean, so we had the GDP data out this week. Now, we did have a big 3% annualized gain in the second quarter, but that was essentially just reversing a contraction in the first quarter surrounding volatility in the import and export data. Cutting through all that, the thing we look at is sales to private domestic purchasers. They only grew by 1.2% annualized in the second quarter, which is actually looking quite positive compared to some of these payroll numbers today. But it's clear the economy has been weak. But then again, is that particularly surprising given just how much disruption the Trump administration caused with its Liberation Day tariff announcement at the start of April? You know, probably not. I think there's still a case here to be made that this is really the peak of the negative effect. We know how much negative sentiment there was in the business and consumer surveys after that announcement. We've generally seen all of those things bounce back more recently. And indeed, payrolls in July were stronger than in May or June, or obviously with the caveat it could be downwardly revised in next month's release. So, you know, I think it's a bit too soon to say that the economy is suddenly falling off a cliff. Really, this is what we might have expected to begin with, given the scale of the disruption.
I was just looking at Truth Social. I had anticipated a comment from the president, and sure enough, quote unquote, too little, too late. Jerome Too Late Powell is a disaster. Drop the rate. Just before this payrolls numbers came out, there were two statements, one from Christopher Waller, one from Michelle Bowman. These are the two dissenters at the Fed policy meeting this past week. Waller warning that jobs growth was at quote unquote near stall speed. Both basically warning the Fed's risking its employment mandate by not acting to cut rates now. I mean, this has got to put pressure on Powell for that September meeting, right?
It certainly does, but the big argument against this is that the unemployment rate only edged up in July. So it's now back at 4.2%, where it's been more or less for the last year or now. And that was really Powell's whole sentiment from after the Fed's meeting on Wednesday, where he pushed back against this idea that it's just labour demand we need to be concentrating on, which is clearly weakened. And really, it's the combination of the balance between labour demand and labour supply, which is also weakened. So once again, in this report, we saw a contraction in the labour force, which is why the unemployment rate hasn't really been increasing that much recently. I think there is still something for both sides of the debate to take from this report. And even though market odds have now moved back to pricing in kind of an 80% chance of a September rate cut, we've still got another employment report, which could well show a stronger result given the idea that we're past the worst in terms of the disruption. And of course, we do still have two sets of price data, which could reveal much more concerning tariff price effects.
Yeah, we were talking just before we started recording. I mean, this report has managed to push the latest White House tariff announcements off the front pages. They were only there briefly, weren't they? Remind us where the effective tariff rate is going to be once these latest numbers, assuming they all kick in. I know there's another 7 days before they do, but how do you think that will change the inflation picture? Because that's the other issue, isn't it? That the Fed doesn't want to move because of this uncertainty around what exactly tariffs are going to do to the US inflation story.
Yeah, exactly. So we released a report on this today with all the details, but the short message is that we expect the effective tariff rate now to be about 17%, which is a little bit higher than we've long assumed, which was kind of an average rate of about 15%. That difference really isn't going to be big enough to concern the Fed. The key issue is just how fast are those tariffs going to feed through. And we haven't seen that much evidence so far, certainly not enough to prevent a cut if we get another weak employment report for August. But these next couple of months, businesses now have a bit more certainty about the tariff framework. Tariffs are obviously feeding through. We have seen some evidence of that in the June data. So it's really just going to be to what extent do they now feed through in the next couple of months.
Jonas, what do you make of this report? I mean, how is it being received in markets? I mean, markets have been relatively buoyant over the past few weeks. Then we've had this tariffs announcement. Got now with this employment report. What's the story there?
Well, I think the big story in markets is this is a pretty massive move, lower in bond yields, as you would expect. Bad news on the economy, higher recession risk. The knee-jerk response is to buy bonds. 2-year yield is down almost 20 basis points off the back of this. It's undoing a bit of a rise over the rest of the month. You're seeing this echo all across the curve. So it feels actually a bit similar. We were talking about this before, but similar to this time last year when there was another payroll surprise. Big negative, and you had a big fall in bond yields then, and also it's feeding through obviously to the dollar, which had been perking up over recent weeks. So it was on track for its best week of the year before this happened, but that's gone into reverse, obviously. If you think about the equity market, I guess the surprising thing is that futures at least aren't down by that much off the back of this report. Now, some of that is not you get a big offset from lower discount rates, but the stock market definitely is down a little bit on the week, and it is down today, but it's not like last year where you saw a massive sell-off into risk assets, and that's not something we're seeing as of yet. The market's still digesting this data. It came out 40 minutes ago, but it's in that way it's not at all like last year.
On the equities front, how much support are we getting from the earnings side, particularly for this AI narrative? There seems to be some of the reports have been coming out seem to have given comfort to the idea that actually the capex boom is still running, and B, that there have been signs that actually some of these investments are paying off.
Yeah, I think that's the other news that has gotten pushed off the front page, as it were, now. But we've had most of the big Magnificent Seven firms report earnings over this week and last, and not uniformly, but by and large, have been very positive with earnings beats, increased capex. So it's all on board the AI train. And as you say, it's not just that the capex figures are rising a lot. It's also that it's showing up in earnings now, or at least they say that's what's driving earnings high. It doesn't really matter. Earnings are up, beating expectations, so the stock price goes up, and that has been increasingly the main driver for the stock market over recent weeks, and we're moving from a world where the equity market rebound since April was a sort of a relief rally from the fact that tariffs aren't going to be that big of a deal in the end. Some of the uncertainty around US fiscal policy gone earlier this month. I don't know exactly where we stand on Fed independence now, but that there was a sense that that narrative was also dying down a bit. So moving a lot of the negatives that might be holding the stock market back. But the positive driver increasingly has been this narrative. It's tech leading the way again, as it was back in the first half of 2024. We're getting back to that world where tech is the only game in town. But certainly at the index level, that is enough to keep driving the US stock market higher. We'll see how this plays out now. That was coming in the context of the economy being slower than last year, but still relatively resilient. If that resilience comes into serious question, then you have this push-pull between, is the area narrative strong enough to overcome that? If we're right that the economy still holds up, then I think the answer to that is, and then we'll see probably further gains in the stock market. If there is a recession, though, I think that would outweigh even the AI narrative.
Stephen, what are these next key releases to be watching here? I know you touched on what we're expecting between now and that Fed meeting mid-September, but what specifically, in terms of the timeline, should we keep an eye out for?
Yeah. I mean, there's quite a few things. I mean, Jonas mentioned about recession risk here. I mean, I should kind of qualify all this with, to a large extent, what we've just seen is what we've been forecasting, right? These immigration restrictions are weighing on labour supply. So we've been forecasting a drop in average monthly payrolls growth to around 50,000 and a modest rise in the unemployment rate as a result of softer labour demand. So I don't think we've certainly not seen enough yet to be too concerned about recession risks. Really, this just supports the forecast that economic growth is likely to be much weaker over the rest of this year than was the case in 2024, partly as a result of these policy changes. But certainly we'll be needing to pay a much closer eye now to the activity data, so not just for the labour market data, but also retail sales, which we'll get around the middle of the month to see how consumers are responding to the policy uncertainty. And also, the weekly data like initial jobless claims, which actually dropped back again last week and are certainly not consistent with the economy about to fall off a cliff. And then on top of all that, obviously, the price data. So from the Fed's perspective, it's worried about both sides of its dual mandate, but we have to take this in the context of the Fed funds rate currently being far above most estimates of a neutral rate. So clearly the bias is towards lowering rates at some point, which is exactly what the Fed is projecting. So it could do that either because the labour market is weakening by more than it anticipated, or because there's less upside risk to inflation than anticipated. So the Fed is expecting inflation to pick up, but if the next couple of months of price data show that prices are rising by a little less than maybe expected, then it also gives the Fed the green light to cut a bit earlier than we've been assuming.
And Jonas, talk to us about what's been going on with the dollar. There had been some signs of recovery up until this release today.
Yeah, July had been a pretty good month for the dollar. It's still up on net on the month and actually up on the week on net as well. One of the drivers for that had been the fact that US data had come in generally showing resilient and better than expectations. And obviously we had the Fed meeting earlier this week where Powell came across quite hawkish and pushed back on the idea that rate cuts were imminent. But at the same time, rate expectations in most other major economies had been drifting up as well, and interest rate differentials on net before today hadn't really moved on the month. And so what was driving the dollar's rebound was a narrowing of that gap between rate differentials and the dollar exchange rate, which had opened up back in April and never closed. So it was an improvement in a more sort of nebulous way. Sentiment around the dollar was improving, I think, because of the policy uncertainty coming out of the administration was fading on several fronts, as we talked about, in terms of tariffs, in terms of fiscal, to some extent in terms of Fed independence as well. And so he was getting, the dollar was benefiting from that. I think now with today's news, we've seen a very sharp drop in the dollar. I think it's down more than 1%. Looking at the DXY index, more than that against things like the euro and the yen. So I think it calls into question the dollar rebound, certainly, if the rate cuts, we had been assuming the rate cuts are going to come next year, and that in the interim, the dollar would continue to rebound as interest rate differentials move in its favor. But I think that it's now looking a bit dicey.
That was Jonas Goltermann and Stephen Brown on a grim US employment report, the US macro outlook, and what the Fed will do next. I will add key bits of analysis around tariffs and the US economy to the show notes. On tariffs, I just want to highlight two data tools to help you navigate this uncertainty. Our tariff impact model lets you plug in rates and spits out global GDP outcomes so you can gauge the damage from different country and sector level duties. And our US-China rerouting dashboard does what it says on the tin. Transshipments of Chinese goods are central to this US-China trade row. This interactive tool shows you how Chinese goods are being moved through third countries like Vietnam and the balance of payments implications. I'll link to both in the notes. Now, it's been a tough end to the week for markets generally, but big tech did have a good start after Microsoft and Meta earnings signaled that the great AI capex boom is still going on and that those investments could be paying off. Hyperscalers like them are on track to invest what could be trillions of dollars in the AI build-out before the end of this decade as part of a global race for leadership in this emerging technology. That implies massive demands for energy to run AI development, its diffusion, and its rapidly expanding range of applications. And Olivia Cross from our climate and commodities team has been analyzing just how much electricity demand there could be and what this all means for global energy markets. I spoke to her earlier this week and I started by asking how much demand from AI is set to grow.
Currently, at the global level, AI and data centers, they're not the most significant source of power demand. They're about 1.5% of global electricity consumption. That's set to rise to about 3% by 2030, obviously doubling. But over that period, power demand from other sources, things like the electrification of industry, cooling demand from air conditioning, all of those things are set to be bigger drivers of growth at the global level. But what's interesting about AI and data centers is that their power demands are very unevenly spread geographically. So that masks a much bigger impact at a country or even a more granular level, when you're talking about areas within a country. So just for example, in the US, data centers are a higher share of electricity consumption. It's more like 4%. But if you were to look at Virginia, which is really the data center hotspot of the world, it's actually closer to 25% of electricity consumption. In Virginia, capacity currently is about equal to 45% of capacity in the whole of Europe at the moment. I think that demonstrates really clearly that AI and data centers, they are going to be a really important driver of change in energy markets, but you wouldn't necessarily appreciate that by looking at the global numbers. So the places where you're likely to see the biggest impact, we think, is in developed markets. And you might think, well, why is that? The US is obviously the leader of the data center build out, but China is hot on its heels in second place. Surely you'll see a big impact there. And you will, but the important context is that in China, electricity demand has already been growing rapidly. So data centers are just one piece of a much bigger puzzle. In developed markets, electricity demand has been mostly stagnant for the past 2 decades. So there is where we think that data centers and AI will be a much bigger driver of growth. Just for example, the IEA has suggested that data centers could drive around 5% of demand growth in emerging markets. That's between now and 2030. In developed markets, they think that could be closer to 20%, and in the US, almost 50%. So I think that demonstrates why that could create bigger challenges for energy systems and participants in certain areas over others.
So huge demand coming from the rollout of AI from these data centers, but also, as you say, just generally as economies develop, as new industries emerge. How prepared are economies to meet this rising demand, given this underinvestment in grids in developed economies in recent years?
Obviously, as we've mentioned, this is going to be a big change in the status quo for developed markets. That's the key things. So you have utility firms, regulators, policymakers who are all used to this environment of very limited demand growth. So I think that will be a challenge to respond to, particularly at the speed at which data centers are being rolled out. I mean, they can be built as quickly as 12 to 24 months. So you're talking about a really immediate need for power. When utilities, for example, they typically operate on 10 to 15-year planning cycles. So it really will be a challenge for all parts of the energy system. Utilities need to adapt their planning systems to make sure that they're responding quickly enough to new requests. You need to make sure there's sufficient electricity grid infrastructure. That's going to need big upgrades and a lot of investment. And it's also a challenge for supply chains for things like electrical equipment, components. Because of that low growth environment prior, firms haven't necessarily invested significantly in expanding their manufacturing capacity. So, scaling up production, that all takes time. And it's why you're seeing headlines now about power transformer prices rising by 75%, or the lead time for specialized cables extending up to 5 years. It's because this increase in power demand that we've already seen it's really taking people by surprise.
If the global rollout of AI can be framed as a sort of technology arms race between the US and China, how are these two powers positioned?
There's obviously a few different ways you can look at a question like this, from an energy market perspective, obviously the US, they are the biggest player when it comes to data centers, their capacity, their electricity consumption at the moment. And they are likely to probably remain in that top spot in the near term. But if you were to look at, say, China's share of the global data center market, at least when you're looking at installed capacity, that is probably set to grow faster than it is in the US. So they're kind of catching up in a way. And, we've identified that the biggest risk to the data center rollout isn't necessarily a lack of energy supply, but it's getting it to the right places quickly enough. That's the thing that could interrupt this data center rollout that is needed to support AI. And in some ways, China probably is better placed to meet those challenges for two reasons, I would say. The first is that having a more centralized system means that China is probably better placed to coordinate things like the build out of grid infrastructure, the construction of new energy sources. They can use things like state-owned enterprises to pursue some of those requirements quicker. And second is, as we've said before, electricity demand in China as a whole has already been growing rapidly. So this is much less of a change in the status quo, and you have that investment in energy supply chains already ongoing. That's part of the reason we've said, for example, China's better placed to take advantage of nuclear energy because they're already adding more nuclear capacity. They've already developed those supply chains and labor market skills, whereas in advanced economies, we've kind of de-emphasized nuclear in recent decades. So I'd characterize it as US in top spot for the moment, but, China is perhaps better placed to meet some of these challenges, and you could see quite rapid advances in China.
Your report does talk about the role that nuclear is playing in the US AI build out. You highlight that Microsoft agreement to restarting 3 Mile Island. Talk about the sources of energy. Where's the energy going to come from? Is this a renewable story? What's going to be the driver of this build out?
Yeah, no, definitely. Tech firms have been a really important part of driving demand for low carbon energy. They've got very ambitious net zero pledges, and they have demonstrated in some of these agreements that they are willing to pay a premium for low carbon energy. It's part of the reason why there was so much excitement about renewables, part of the reason there was so much excitement about nuclear. As we enter this kind of period of very rapid demand growth, particularly in the next 5 years, it will really be all about which power sources can be deployed most rapidly, whether those are low carbon, whether those are fossil fuels. Renewables on that front do actually do very well, particularly solar. In some cases, you can see construction completed in 12 months. So, and that's one of the reasons why we see renewables to drive probably the majority of incremental power demand between now and 2030. Obviously, with data centers, though, you do need the access to constant power supplies. You'll need sources of what we call baseload power, which, on the low carbon side, that's where energy storage and nuclear come into the picture. Our impression, though, is that this is probably more of a 2030s, 2040s story. In the near term, that baseload power is probably going to be met by fossil fuels. Particularly in the US, we see scope for quite a big increase in natural gas demands because in the US, it's pretty quick to construct, and in the US, gas supplies are plentiful and they're cheap. And so that's one of the reasons why we don't expect natural gas consumption globally to peak into the 2030s, and consumption probably wouldn't drop off meaningfully until more like the 2040s because it is being supported by this data center rollout.
The other key point that you raise in your report is that AI itself might play a role in defining how much energy demand it requires. One of the reasons I think DeepSeek dominated headlines in January was because reportedly it is so much more power efficient to run than the more established LLM. So talk about what AI could do in terms of defining power demand.
One of the things not to understate with all of this is there's just so much uncertainty when you're thinking about the scope of AI's power demands, not least for the fact that efficiency gains, they're going to be determined by technological progress. And that's just something that we can make assumptions about, but we have no idea about really. And I think when DeepSeek announced their R1 model, they really changed the perceived wisdoms about the scope for efficiency gains. Prior to that, some of the estimates in the US were really staggering, and they've definitely been tempered a lot since then. What I would say about DeepSeek, though, and these efficiency gains is that to the extent that they can make developing models, training models, accessing AI cheaper, easier, more efficient, using less energy, inevitably the response to that will be we'll find more uses for AI. We'll find that AI's use cases expand, it's adopted more broadly, and inferencing, which is using AI for real world applications, is done much more frequently. While inferencing obviously isn't as energy intensive as developing and training these models, it's much more energy intensive than other digital tasks, and it already makes up the lion's share of AI's energy needs at the moment. So to the extent that there are an unimaginable range of options in which we can use AI to improve energy efficiency in a range of industries, or kind of improve electricity grids, make energy management more efficient, if we broaden out the adoption of AI, increase the amount at which we're using it, eventually that's going to lead to more energy consumption in the long run.
Olivia Cross there, talking about AI's energy demands. I will add her report to the podcast notes, as well as our key issues page, all about the macro and market impact of this technology. But that's it for this week. Neil will be back next week, where we will be picking up on this tariff situation, talking about how the global macro story could be shifting, and reviewing that Bank of England decision that's happening this coming Thursday. Until then, goodbye.